to many people, it looks like we're seeing a massive inflow of what you would call dumb money going into the market at the worst possible moment, right when the economy is on the brink of collapse. Now, whether it has been done on purpose or not, the reality is that the financial system incentivizes investors to go into the stock market at the very peak. You see, when the economy begins to crack, with layoffs picking up and GDP growth slowing, that prompts the central bank to cut interest rates to stimulate the economy. This reduces the incentive to hold cash and increases the incentive to invest in assets, whether that be stocks, real estate, or crypto. The only problem is that the economy is cyclical, and that this deterioration usually turns into an outright contraction, which eventually makes all of these assets turn back down. This is exactly what happened in October of 2007. As you can see, the S&P 500 index was making a new all-time high as it was being pushed higher by the Federal Reserve that was cutting interest rates. These interest rate cuts were reducing the incentive to hold cash and pushing investors to allocate to stocks. And so they did. Just in the final stages of this rally, investors accumulated $150 billion of margin debt. And all of this was happening right as the US unemployment rate was beginning to turn back up. So investors were pulled into stocks right before the onset of the great financial crisis.